Picture this. It's the start of the new financial year, and your clients are frantically blowing up your phone asking, hey, where do I claim my tax-saving investments this year? Did the new law wipe out all my deductions? Well, take a breath, because welcome to this legal explainer on the brand new deduction framework under the Income Tax Act 2025. I'm your host, and today we're going to decode Chapter 8-B, specifically Sections 123 to 137. This is the new rulebook for deductions in respect of certain payments. Let's dive right in and get some much-needed clarity on this whole new taxation landscape.
So, the most common question I'm hearing from professionals and taxpayers alike is, how exactly do our go-to tax deductions fit into this new 2025 framework? I mean, for literally decades, Section 80C has been totally synonymous with tax saving here in India. And with the repeal of the old 1961 Act, there's a lot of apprehension. But don't worry, the core idea of incentivizing your savings and specific expenses, that hasn't vanished. It's just been completely restructured and modernized. To get us there, today's agenda will cover the new deduction framework, key Chapter 8-B provisions, a real-life taxation example, compliance and practical issues, and finally, key takeaways and a summary.
All right, Part 1. The new deduction framework, bridging the acts. As you can see here, familiar concepts are definitely still around, but they're now living under Chapter 8-B, specifically Sections 123 through 137 of the 2025 Act. This basically shows us that the substantive tax reliefs haven't disappeared into thin air. Your old favorite, 80C, that's now Section 123. Rent-paid deductions under 80GG, they've moved over to Section 134. Political contributions shifted from 80GGC to Section 137, and maintenance for a disabled dependent hopped from 80DD to Section 127. Trust me, memorizing this mapping right here is going to save you so much time when advising clients or updating your software systems.
Moving on to Part 2, key Chapter 8-B provisions, the law explained.
Okay, the absolute core of this is Section 123. The good news? It completely preserves that 1.5 lakh aggregate limit we all know and love from the old 80C and 80CCE. But, and this is a big but for professionals, the eligible instruments, things like life insurance premiums, provident fund contributions, tuition fees, they are now strictly defined and consolidated under Schedule XV of the Act. You literally have to refer to this schedule to verify if something is eligible now. Oh, and a quick reminder, this deduction is strictly for individuals and HUFs.
Now, beyond your standard savings deductions, the Act carves out some other really specific targeted reliefs right within this same chapter. For instance, we've got Section 125 for contributions to the Agni-Veer Corpus Fund under the Agnipat scheme. We also have deductions for housing loan interest. Those are cleanly separated out now under Sections 130 and 131. And for the self-employed folks or salaried individuals who aren't getting house rent allowance, well, Section 134 steps right into the shoes of the old 80GG to give you that relief for rent paid.
Here's a massive advisory point when it comes to choosing your tax regime. Section 123 deductions absolutely cannot be used if the taxpayer opts for the concessional tax regime under Section 202. The official FAQs are crystal clear on this. So if your client is eyeing those lower tax rates under Section 202, they've got to completely let go of these Chapter 8-B benefits. It's a hard either-or scenario, just like the old regime, but obviously governed by these new statutory sections.
Let's look at Part 3, Real-Life Taxation Example, Computation Mechanism.
So when you're actually sitting down to compute this, you need a structured approach. Step 1, first you determine the gross total income or GTI from all heads of income. Step 2, aggregate every single investment your client made that qualifies under that new Schedule XV and apply Section 123. Just remember to cap it at 1.5 lakhs. And Step 3, this one's critical. You have to make sure the total deductions do not exceed the GTI. This rule, which now lives under Section 122, basically stops deductions from creating a loss that you'd carry forward. You can reduce taxable income all the way down to zero, sure, but absolutely no lower than that.
Which brings us to Part 4, Compliance and Practical Issues, Timelines and Transition.
All right, pay super close attention here because this is a massive statutory warning pulled straight from the official guidance. Failing to file the return within the prescribed due date will entirely invalidate your claim for these deductions. No joke. Section 122, subsection 5 enforces this strictly. So, if your client files a belated return, boom, they lose out on all those Chapter 8-B deductions. Filing on time isn't just a best practice anymore, it is a hardcore legal prerequisite to actually get the benefit. Looking at this timeline from the official FAQs, you really need to draw a hard line between filing for assessment year 2026-27 under the old Act and tax year 2026-27 under the new 2025 Act. Did you catch that? The terminology actually shifts from assessment year to tax year. So to avoid awful portal validation errors, you've got to ensure that for income earned in financial year 2025-26, you're filing under the old Act. But for income earned from April 1, 2026 onwards, you use the new tax year 2026-27 forms, which are governed by the new Act.
Now, for all the business owners and accountants tuning in, here's your immediate action plan. Employers and software vendors absolutely must update their payroll and ERP systems before April 2026. Why? Because employee investment declarations and Form 16s have to correctly reference Section 123 in Schedule XV instead of the completely obsolete ADC. If you keep using the old section numbers after April 1, 2026, you're looking at system rejections and a total compliance nightmare.
And hey, while we're on the topic of compliance, I've got to highlight a really common practical mistake with business deductions. Ignoring TDS is incredibly dangerous now. Under the new Section 35-B, which basically replaces the old 40A, if you fail to deduct or deposit TDS, it triggers a brutal 30% disallowance of the expenditure. So think about it. If a business pays 5 lakh rupee in professional fees but totally forgets the TDS, 1.5 lakh rupees is going to be slapped right back onto their taxable business income. Ouch.
You might be wondering, wait, what about my ongoing claims? Well, take a deep breath. Fortunately, Section 536 of the new Act is your safeguard. It explicitly protects transitional rights. This means your valid deductions, any options you've exercised, and brought forward losses from the old regime successfully cross the bridge into the 2025 framework. Basically, as long as the claim was legally valid under the old 1961 Act, you don't just lose it because the law got an upgrade. You've got continuity.
Finally, Part 5. Key takeaways and summary. Final review.
All right, let's wrap this up with 5 key pillars you need to remember. First, ADIC is out. Section 123 is in, but it keeps that 1.5 lakh limit via Schedule XV. Second, your deductions can never, ever exceed your gross total income. Third, filing your return on time is an absolute statutory must to claim these benefits. Fourth, Chapter 8-B deductions are completely mutually exclusive with the new concessional tax regime. And fifth, corporate folks update your ERP and payroll systems immediately. Nailing these points means you are totally ready for this new era of Indian taxation.
This transition to the 2025 Act isn't just about memorizing some new section numbers. It's about fundamentally rewiring your compliance strategies. So you've got to ask yourself, are your clients truly ready for April 1st? Or are their legacy systems walking them straight into a massive compliance trap? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.